The world of investing can seem like a thrilling yet daunting adventure. Two popular options often steal the spotlight: stocks and gold. Stocks represent the excitement of owning a piece of successful companies. Gold, on the other hand, symbolizes stability and security, a haven in times of economic storms. Both investments offer unique advantages and disadvantages. Understanding these nuances is crucial for any investor, especially those just starting their financial journey. Let's break down these two investment giants, exploring their pros and cons in simple terms. This will help you make informed decisions tailored to your financial goals and risk tolerance. Imagine owning a tiny slice of a giant apple pie. That's essentially what a stock represents, a small ownership stake in a publicly traded company. When you buy a stock, you're buying a piece of that company's future earnings and growth potential. Companies issue stocks to raise capital for expansion, research, or other business endeavors. As a stockholder, you become a part owner, sharing in the company's profits and experiencing its losses. The value of your stock fluctuates based on the company's performance and overall market sentiment. Investing in stocks can be like riding a roller coaster. There are exhilarating highs and stomach-churning lows. The potential for high returns is a major draw for stock market investors. When a company performs well, its stock price generally goes up. This allows investors to sell their shares for a profit, known as capital gains. Besides capital gains, some companies also distribute a portion of their profits to shareholders as dividends. However, the stock market is inherently volatile. Stock prices can swing dramatically in short periods due to various factors, such as economic news, political events, or even investor sentiment. This volatility means there's also a risk of losing money if the stock price falls below your purchase price. Investing in stocks requires careful research, a sound understanding of market dynamics, and a willingness to withstand short-term fluctuations. Gold, the shimmering safe haven in uncertain times. Gold has been a symbol of wealth and stability for centuries. Unlike stocks, gold is a tangible asset. It has intrinsic value, meaning its worth isn't solely derived from market perception. During times of economic uncertainty or political turmoil, investors often flock to gold as a safe haven asset. This is because gold tends to hold its value or even appreciate when other assets like stocks are declining. This makes gold a good hedge against inflation and a valuable addition to a diversified portfolio. However, it's important to note that gold doesn't generate income like stocks that pay dividends. Its returns come solely from price appreciation, which historically has been lower compared to the stock market's long-term growth. Additionally, storing physical gold can be costly and inconvenient, involving security and insurance considerations. Finding your investment path: stocks, gold, or both. When deciding between stocks and gold, consider your financial goals, risk tolerance, and investment timeline. If you're aiming for potentially high returns and have a longer time horizon to ride out market volatility, stocks might be a good option. Just remember to do your research and choose companies with solid fundamentals. If you're seeking stability and a hedge against economic uncertainty, gold could be a valuable addition to your portfolio. It's often seen as a safe haven asset that preserves wealth during turbulent times. However, keep in mind that gold's returns might be lower compared to stocks over the long term. Many investors find that a balanced approach incorporating both stocks and gold works best. This diversification strategy helps mitigate risk by spreading investments across different asset classes with varying levels of volatility and growth potential. Ultimately, the best investment strategy is one that aligns with your individual financial goals and risk appetite. Before making any decisions, consider seeking advice from a qualified financial advisor to make informed choices tailored to your unique circumstances.